you ask any experienced traders, they would always say that a bull market is easier to trade compared to a bear market. What's the rationale behind it? Why do people think that bullish markets are much more easier to trade? Because it's a general human tendency to be able to buy anything, but to selling is a difficult art. And that's why it becomes psychologically difficult to trade a bear market than a bull market. Hi everyone, my name is Hitesh and I welcome you all to TradeBrains YouTube channel. Now through this video we'll be understanding what are the most bearish candlestick patterns in the market. There are many bearish candlestick patterns, but we'll be choosing the top 3 most bearish candlestick patterns, and which more often than not gives us more convincing trades than any other candlestick pattern. So let us jump right into our discussion. So the first candlestick pattern which I'll be talking about is the concept of bearish Marubozu. Now what exactly is a Marubozu? Marubozu is that form of the candlestick pattern in which the whole candle is like a body. There is no upper or lower shadow. The top of the candle and the bottom of the candle are just covered by the complete body. Now what would a bearish Marubozu mean? So a bearish Marubozu would simply mean a candle in which the top of the candle is the open of the candle and the bottom of the candle is the low of the candle. So let us just jump into our discussion of the same concept. Now if you look at this chart here, I have pointed my cursor on the center of a screen. The prior pattern here is a bullish one to stable one. The market looks on an uptrend. We get a big green candle. But on the following day, we get a big red candle which is completely like a body. It can also be called as a bearish engulfing, but this is more of a better Marubozu pattern because the whole candle is like a body formation. There is hardly any wicks. There is nothing called as perfect pattern. If you get small amount of wicks, which is fine, but in general, the 95% of the candle is covered by a body. And this is a bearish Marubozu pattern. And if you look at the trend of the market after that, the market could never recover from the fall after that, and the price kept falling all the way. The fall started from the price of 1603 for Reliance Industries. And if you're holding a trade for a period of say about 1.5 2 months, you would have got a return of nearly 500 rupees per share. That is a return of nearly 33% on the amount of invested. So which is great by any measurements. So this is one form of candlestick patterns which is loved by all the traders who are into bearish trading, who want to trade a convincing bearish pattern. A bearish Marubozu is a very convincing pattern. Now to add on to the conviction, if you add say a volume chart study, you put a volume chart here. In general, if you look at the prior volume to the prior days to the formation Marubozu, the volumes were on the low side. But the day on which the formation happened, the volume was more than the average, which simply means that the selling was with volume, which always adds on to a conviction of selling in the market. So if you get a candlestick pattern which is again supported by volume or any other technical indicator which you personally use, it always adds more conviction. And the stop loss for this trade was very easy. You just had to put a stop loss above the top of this candle, which the market never reached, and it gave you a very decent return. You could just keep trailing your stop loss and keep riding on the profits which you would have made. So that is the first bearish pattern which I like personally. I use it a lot in my personal trading, and that is one trading pattern which are preferred by all the bears in the market. And the second form of bearish candlestick pattern I'll be talking about is the bearish engulfing pattern. Let us understand what exactly is engulfing pattern. So engulfing pattern is that pattern in which the engulfing candle completely engulfs the prior candle. Supposedly if the prior candle is a red one, then the engulfing candle would completely engulf the next candle with a green candle. And supposedly if the prior candle is a green one, then the engulfing candle will completely engulf by making a bigger red candle. So that is the basic premise of an engulfing candle. Now if you focus your attention on the center of the screen here, you see that the prior trend was on an uptrend. The market was making higher lows and the market was on upscale. And the prior day was again a green candle and the market made a new high. And even on the next day, the market did open above the previous day high and it made a new high, but constant selling, profit booking happened, and the market ended with a big engulfing candle. That is, engulfed the previous day and it made the whole body itself covered the previous day candle length, which is a very bearish pattern in the market. It is advisable to exit all your long and if possible add short positions in the market. It is normally gives you a very good return on a trade. It is a very good risk to reward return trade, and it gives you a return of sometimes to the tune of 10 to 15% on the amount of money you invest, and the market moves very quickly after that. Even if you take the example of this Kotak Bank here, if you're invested even on the next day after the formation of the bearish engulfing candle at around say 1425 levels, and if you just kept trailing your stop loss, you would have still got a return of nearly 12 to 13% on the investment which you made. So that is the power of a bearish engulfing. If a pattern is convincing enough And if it's on a decently long time chart, it gives you a very good risk reward trade, and you are bound to make certain decent amount of profit. I'm not saying that the pattern couldn't have gone wrong. No pattern gives 100% conviction, but a pattern which has been followed by many years by many traders, experienced traders, it has obviously got some reliability to it. Yet you are going to have more hit trades than a flop trades in the market. That is the second bearish candlestick pattern. And the third, which I use personally quite a bit for a short-term trade to medium-term trade, is a bearish doji reversal. Now, what's a doji? A doji is that form of candlestick pattern in which the open and low are very close to each other, or they are almost same, if not exactly same, they're very close to each other. Now, if you look at the chart from the left-hand side of your screen, the market is on a bull trend. The market is constantly making new highs and higher lows in the market, and it's trying to test new highs every day. Even till this state, when the green candle was formed, there was no sign of reversal in the market, and the market was on an uptrend. But on the next day, when the market did go to a previous day high, couldn't breach it, came down and formed a doji candle, it did show a sign of weakness in the market, or the bulls coming out of the market. It felt like that the bullish trend was going to stop for some time, or it's at least going to take a pause here. But on the next day, when the market opened and closed below the previous day candle length itself, it gave you a convincing bearish pattern. It was a good time to short. If you had short on this day at the end of the day around 231 levels, keep a stop loss say around 240 and above it, you would have got a decent return. I'm not saying you could hold all the way. Even if you had held till here also, that is this green candle on the center of the screen, you would have still made a profit of 7 to 8% on your investments. So these are the three kind of candlestick pattern which I personally use if I'm going to look for bearish trades in the market. I'm personally a bullish trader by nature, but I look for bearish trades, and once the pattern are convincing enough, I go for those kind of trades. So three bearish candlestick pattern which we talked about are the bearish Marubozu, the second being the bearish engulfing candlestick pattern, and the third being bearish doji reversal. So that's it from us in this study of the bearish candlestick pattern. I thank you for your patient hearing. I'll see you again in the future videos of financial education. Signing off. Thank you so much.